We touched on a few types of taxes in the last video, but let's zoom in on a very important type, income tax. Let's recap. What is income tax? Essentially, every year you have to pay a percentage of your annual earnings to the Canadian government. The tax is collected by the Canadian Revenue Agency, or CRA, which gives it to the government to fund their operating expenses and services. It's because of our taxes that we can enjoy services such as infrastructure, education up to a secondary level, and basic health care. Before submitting your taxes to the CRA, you can put your income data into an online site to help you calculate it, hire a professional to file your taxes, or do your own calculations in tax filing. Canada uses a graduated tax system, where the more you earn, the more you pay. The money is divided into income brackets, which determines the applicable tax rate for you. A common misconception is that if you're in a higher tax bracket, you're charged that amount for all your income, but you're actually charged gradually. At first, you pay the tax rate placed on the lowest bracket, and with every additional dollar, you start paying higher rates. Let's look at this on a very small scale with imaginary numbers. Say the lowest tax bracket has a rate of 10% and applies from $0 to $10. The second tax bracket has a rate of 20%, applying from $10 to $20, and the third tax bracket has a rate of 30%, applying from $20 to $30. Say your whole income for the year is $30, you don't pay 30% on everything, that's a whole $9. With graduated tax, you'd pay 10% on the first $10, which is $1, pay 20% on the additional $10 between 10 and 20, which is $2, and 30% on the additional $10 between 20 and 30, which is another $3. If you add that all up, that equates to $6 rather than $9. For a more realistic scenario in the real world, explore a module for an activity that models it. Graduated tax rates can be extremely confusing because the tax brackets don't depend just on income, but also location, as income tax rates vary and are decided by the province. The CRA doesn't tax all sources of income the same way. For example, corporate income gained from employment or small businesses, gains on investments, dividends from companies, and other income would still be calculated gradually, but with different rates. Now, different sources of income vary on their tax rates, but also vary further. Some sources of income don't get taxed at all. Sources of income that get taxed include employment income, regardless of whether you work for a company or are self-employed, dividends, interest, profits from investments, pension income, and foreign income. They'd all be taxed, a percentage of them being collected by the CRA. Now, income that wouldn't be taxed include lottery winnings, inheritances and gifts, child benefit payments, life insurance payouts, and scholarships. Tax as a whole, types of tax, and especially the graduated tax system can be really confusing. Please, though, try to wrap your head around it, as they're inescapable when you start earning money to make a living.